The stock market just made headlines with a shocking 10% rebound in a single day. But is this explosive rally the start of a powerful bull market, or a dangerous trap setting investors up for more pain? Stick around because we're unpacking the data to keep your investments safe. After weeks of panic driven by Trump's tariff proposals, the S&P 500 plunged over 20%. But now, investors witnessed a stunning comeback, a rare 10% jump in one session. Moments like these mark turning points in history, like after the 2008 financial crisis or Black Monday in 1987. Pausing tariffs for 90 days might calm investors, but it doesn't automatically prevent a recession. Historically, rising unemployment is a key recession signal. Every recession since the 1940s has been accompanied by job losses, with markets typically bottoming only after unemployment peaks. Quick fact: markets bottom about 6 months after unemployment peaks. Timing is crucial. Another powerful recession predictor is the yield curve inversion, which happens when short-term yields surpass long-term yields. Currently, the curve has re-inverted. That's a rare event, typically signaling continued economic strength and a strong job market, not a recession. Key insight: historically, yield curve re-inversions often signal bullish, not bearish markets. But there's a twist. Although the yield curve re-inversion suggests strength, market volatility remains elevated, driven by uncertainty over geopolitical tensions and trade negotiations. Investors should remain cautious, keeping an eye on international events that could rapidly shift sentiment. However, a worrying sign emerged. The gold-to-silver ratio surged 15% in 1 week. This spike often indicates investors are seeking safety, predicting downturns. Similar moves occurred before the 2008 crash and the COVID-19 market collapse. Another key indicator we haven't discussed yet is real estate. Housing markets often precede economic slowdowns. Currently, housing prices are showing signs of cooling, with mortgage rates fluctuating sharply. While there's no clear collapse yet, reduced home affordability may be signaling underlying economic weakness. At Investment Melon, we're cautiously optimistic. While risks remain, unusual signs like the yield curve re-inversion hint at potential strength ahead. However, we're patient. We won't jump in without clear evidence. Our strategy remains diversified, with cautious positions in defensive sectors and precious metals, while we await clearer market signals. Patience helped us secure a remarkable 60% return in 2024, double the S&P 500's performance. Quick recap: recent 10% market bounce signals potential, but caution is crucial. Monitor unemployment closely as an early recession indicator. Yield curve re-inversion points to strength, not recession, but volatility remains high. Gold to silver spike is a serious warning sign. Don't ignore it. Real estate market softness could precede broader economic slowdown. Enjoyed this deep dive? Click subscribe, hit the bell for notifications, and join our community. Markets move fast. Stay ahead and protect your gains. Thanks for watching. Invest smart and stay sharp.